Hello, ladies and gentlemen. I welcome you all to Questions. In the last chapter, we've dealt with the Great Depression of 1929 and how it led to the rise of Hitler, and this led to the rise of World War II. And later on, through this, we've learned a few basics of microeconomics like demand and supply, like consumer behavior. And after that, we've entered macroeconomics and we've dealt with the chapter inflation. We've seen that too much of inflation will lead to something in Hungary, and too little inflation means economic stagnation. We've also seen that inflation, when it's a pinch of salt, that is exactly 2 to 6%, is good for an economy. And it is the duty of the RBI to maintain inflation in this bandwidth. Alright? So in this chapter, we'll be looking at the Central Bank of India, that is RBI, and how it controls the price rates in the market. How does RBI control the price rates in the market? How does RBI control the inflation in the market? Through using something called monetary tools. Before going into what monetary tools and how these monetary tools will be helpful in decreasing or increasing inflation, let us look at few facts of RBI which are very relevant for the prelims. It is commissioned or established through the recommendations of Hilton Young Commission through RBI Act 1934 with two major functions, that is, one, to regulate the banks within the India, two, be the banker to the government. But later in 1949, RBI was nationalized, and since then it technically is no longer a bank. I said technically it is no longer a bank. What is a bank in first place? Bank is an institute that accepts deposits from the public, that is the common people, you and me, and the companies. It also gives loans to the common people and the companies. Today, RBI doesn't accept deposits from common people, nor it doesn't give loans to the common people. So what does RBI do? After nationalization, through amendment of the RBI Act 1934, the functions of RBI is broadened. The first function of RBI is it is a monetary authority. For this, the government came up with Monetary Policy Framework Agreement, which has statutory backing because the RBI Act 1934 were amended, and this agreement was given a statutory backing. Alright. Before going into what is Monetary Policy Framework Agreement and else, I would like to introduce you to two terms here. What is bank and what is a scheduled commercial bank? Bank, we've already seen what it is. Scheduled commercial banks are those banks which are mentioned or listed under the second schedule of RBI Act. Right? These are scheduled commercial banks. So the basic functions of the bank: give loans and take deposits from the public. That is you and me. There is another term that I have to introduce you to, that is NDTL. What does NDTL stand for? Net Demand Time Liabilities. Okay, before understanding what this is, we have to understand what is an asset to a bank and what is a liability to a bank. What is an asset? The loans the bank gives is an asset because the bank will be paid back the loan with some interest, that is, with some profit. And what is a liability to a bank? A liability is the deposits that you and me deposit with the bank because it has to pay back to the consumers whenever they demand. So deposits are of two types. One is demand deposits, one is fixed deposits. Demand deposits are those deposits that doesn't have a tenure, that is no fixed timeline. We just demand the money whenever we want, like we use our ATM card or draw the cash, right? There is another deposit that is fixed deposit, that is it has certain tenure like 1 year, 2 years or 10 years, and it has higher interest rate than a demand deposit. The bank will only give you back the money after the expiry of this 1 year or 2 years or whatever the tenure is, with the interest rate such promised. So, what is NDTL? NDTL are nothing but net demand, that is normal demand deposits, plus time deposits, that is fixed deposits, which are liabilities. So, net demand and time liabilities, that is nothing but NDTL. We will be using this term frequently in this chapter, so just remember what NDTL is: net demand and time liabilities. So yes, before going into how monetary tools affect the inflation, let us see a little backstory. Why that monetary policy framework agreement have to come into picture. Before 2016, RBI alone used to decide the monetary policy. That means how to use those tools to control inflation. To increase transparency and accountability, government introduced monetary policy framework agreement. It is an agreement between RBI and Government of India to basically increase transparency and accountability. Let's see a few basic features of monetary policy framework agreement. Feature number 1 is flexible inflation targeting framework. Under this, the RBI is mandated to maintain the inflation within the bandwidth of 2 to 6%, that is 4 plus or 2% for the 5 years, and then later on it maintains the inflation in the same rate or the same bandwidth even today. And the second feature is establishment of monetary policy committee with 6 members, 3 from RBI, 3 from the Government of India. Within these 3 from RBI, one is the Governor of RBI, one is the Deputy Governor of RBI, and one is any person that is nominated by RBI from the board of the RBI. And feature number 3 under monetary policy framework agreement is if RBI fail to maintain inflation rate within the bandwidth, and if the inflation rate is less than 2% or more than 6%, RBI deems to seen as failed. So RBI have to submit a report to the Government of India. This inflation outside the bandwidth should be for 3 consecutive quarters. What is a quarter? We have a financial year with 12 months, and quarter is nothing but by 4th, that is 3 months is a quarter, and 3 quarters, that is 9 months. So if RBI fails to maintain the inflation within the bandwidth for more than 3 consecutive quarters, then RBI have to submit a report that why it failed to keep the inflation within the bandwidth, and what are the steps it is going to take, and in how much time it will bring back inflation to the bandwidth, that is 2 to 6%, right? So let's now see how monetary policies or monetary tools. What is monetary policy? That is RBI deciding on how to use these monetary tools to adjust the inflation rates in the market is the monetary policy. So let's see what are monetary tools. Monetary tools are basically divided into 2 types. One is qualitative and another one is quantitative. Within the qualitative tools, we see moral suasion, rationing of credits, direct action, margin requirements, priority sector lending. And within quantitative monetary tools, we see what is base rate, what is open market operations, we see what are liquidity adjustment facilities, we see what are reserve requirements, and so on and so forth. But before going anywhere, let's see how banks used to decide their rate of interest, right? The decision on rate of interest has been evolving over a period of time. From 1994 to 2003, banks used something called as prime lending rate. Under this, banks can decide the rate of interest as per their wish. So what happens here? Because banks can decide the rate of interest, banks used to give rate of interest at, for example, say 8% to corporates, and used to give 12% to normal consumers, that the common public, that is you and me. So we, the people, normal public, have a drawback under this regime. So why does it give on lesser cuts to corporate? Because corporates can borrow huge sum of money. For example, 2 crores or 5 crores. So even it is less interest, banks get a lot of money in return. So to make a deal with corporates, banks used to cut their interests when compared to the normal interest given to the general public. And since 2003 to the 2010, banks use something called as benchmark prime lending rate. It is same as prime lending rate, but banks have to decide and declare their rate of interest beforehand. And even then, the same thing happened. It used to cut down, even though the banks declared the rate of interest beforehand only. They used to cut down the interest rates for corporates because they get a lot of money back in form of interest. And after, from 2010 to 2016, they used something called as base rate. Under this, banks decide their rate of interest by calculating their average cost of funds. So let's see what average cost of funds mean. Let's say banks have to pay interest of 5% on demand deposits, right? 5%. Let's say bank took a total demand deposits of 1 crore. Later on, banks have to pay 7% of interest on time deposits, that is nothing but the fixed deposits, let's say 1 crore again. Again, later on, banks have to pay, let's say 3% on the money borrowed from RBI, right? That is 1 CR. So how do we calculate our average cost of funds? Is nothing but we add total interest in funds by total liabilities, that is total funds that the bank have to pay back liabilities. So what is the total interest on this? 5% of 1 crore plus 7% of 1 crore plus 3% of 1 crore by 3 crores. That comes to around 15 lakhs, which is divided by 3 crores. That gives rise to 0.15 crores by 3 crores into 100. How much is that? 5%, right? So now the rate of interest that the banks have to put is 5%. Those are nothing but based on average cost of funds. So after this, the rate of interest has been later based on marginal costs of lending rates or marginal cost based lending rates. So under this, the RBI, or sorry, the banks used to calculate the rate of interest on 3 things. 1, average cost of funds or cost of funds. Again, negative carry on cash reserve ratio. We'll see what cash reserve ratio very shortly, but let me give you a brief. Cash reserve ratio is the percentage of NDTL, net demand time liabilities, that the banks have to deposit with RBI in form of cash or G securities or gold, right? So what is negative carry on CRR? The negative carry on CRR, let me explain here. Because the banks have to deposit some percentage of NDTL, net demand and time liabilities with RBI. Let's say 2% of NDTL net. That 2%, let's say, that is 5 crores. So on this 5 crores, because these are the deposits from the common public, RBI has to pay certain interest, right? Let's say 6% of interest on this 5 crores. But because this 5 crores is with RBI, it cannot give loans it cannot use this 5 crores to give loans and get some interest like 7 or 8 percentage. So what is happening here? The banks are losing some money that it could have been made, or it could have made by giving out loans, right? But there is no money that can be made because the percentage of this NDTL is with the RBI. So the difference between, or let's put it this way, that the amount of foregone amount of interest that is foregone or lost because that the banks are depositing certain amount of NDTL with RBI, this amount that is foregone is nothing but negative carry on CRR. Then day-to-day operations cost, for example, it has to pay the AC bills, it has to pay salaries to the employees. So these day-to-day operations, so banks have to decide on these 3 factors, that how much rate of interest they are going to offer for the consumers, right? This increased little bit of transparency, and it is better than base rate. And right now we use something called as external benchmarks based lending rates. Under this, the banks have to give or put their rate of interest, give loans with an interest linked to the yield rate of treasury bills and the repo rate and any other rate which is mentioned by Financial Benchmarks India Private Limited. It is a company that gives rates, how much is the yield rate of treasury bill. We'll see what a treasury bill is in the chapter capital market, but let me give you a small brief here. Treasury bills are government bonds. That is, government will give you a bond, you pay government some money. So after the tenure of this bond gets expired, you give back the government the bond, you give back the bond to the government, and government will pay you back your money plus some interest, right? These treasury bills can also be traded and etc., which we will discuss clearly in the chapter capital market. But as of now, understand this: as of today, right, the rate of interest that is being decided by the banks is based on external benchmarks based lending rates, which means that the banks have to follow the repo rate, follow the treasury bill yield, follow the rates that have been declared by Financial Benchmarks India Limited, right? So we know how banks decide their interest rates, right? Let's now look into the monetary policies or the monetary tools, specifically the qualitative tools. Number 1, liquidity adjustment facility tools. This is a broad band. Under this there is repo rate, there is reverse repo rate, and there is standing deposit facility. Okay, so let's look what repo rate is. RBI gives loans to a scheduled commercial bank, but these loans require collateral. What is this collateral? Collateral is nothing but G securities. G securities or treasury bills and government bonds, these are basically the same. These are the bonds that the government gives, secured by the government. That's why we call G securities. We'll discuss about all this in chapter capital market. Again, we don't have to understand what they are right now, but understand this much: RBI takes collateral, G securities, and gives loans to the scheduled commercial bank, and because of this, the scheduled commercial bank have to pay back some interest to the RBI. Repo rate, okay, we see what government bonds is. Repo is not technically interest rate, or it is not technically a loan. What happens here is the scheduled commercial bank gives its collateral first, and basically repurchases this collateral again after the tenure of the loan is done, by paying the value of the G security, and also G security value, and also some interest rate. This interest rate is nothing but repo rate. So it is called repurchasing order. All right. Okay. Yes, sir. We understood what repo rate is. But what is the intention here? We are here to learn how this repo rate impacts the market prices, impacts the inflation. Yes. So how does it impact the inflation? Okay, let's see. For example, the RBI increased the repo rate, right? Let's say 10 percentage. Fine. So what happens now? Now, because number one, the repo rate is too high, scheduled commercial banks take lower loans or are discouraged to take more loans. Number one. So less loans means what? Scheduled commercial banks have less funds to give as loans to consumers. That means less money in the market. Less money in the market means less demand in the market. Less demand in the market means less inflation. That is, we are negating the demand push inflation. On the other hand, number two, when the repo rate is too high, what happens? The scheduled bank, commercial bank takes, let's say it took borrowed certain funds on this repo rate. When it is giving loans under external benchmark based lending rate, it has to fix its rate of interest as per the repo rate or the treasury bill yield, right? So because the repo rate has increased, now what? The rate of interest have to increase, right? What happens when the rate of interest increases? That means the banks will give in loans on higher rate of interest. When the banks are giving loans on higher interest, what is happening? Less people will take loans because the interest rate is too high. When there are less people taking loans, less companies taking loans, what happens? There is less spending in the market. When there's less investment or spending in the market, what does it mean? It implies there is less demand in the market. If there is less demand in the market, what does it mean? That is, the prices are not increasing or falling. That is, it implies there is less inflation in the market. So using a repo rate, the RBI can control inflation as such. If the RBI decreases the inflation, what happens? Banks are encouraged to take more loans because the interest rate is too low, and the rate of interest that the banks are going to give to the consumers is also low. So the people and the companies are also encouraged to take more loans. More loans means more money that they can spend. More money that they can spend means what? More demand in the market. More demand in the market means more inflation, right? Hope it's clear. And next, we also have to look at reverse repo rate. It is just opposite of repo rate. Here, the scheduled commercial bank don't take loans, but it rather give money to the RBI. In turn, RBI have to give collateral, that is G securities, to the scheduled commercial banks. Again, here it is not technically a loan. It is not technically a loan. RBI just gives the G securities for some money, and RBI repurchases the G securities with interest on it. That is nothing but the reverse repo. Reverse repo is basically 25 basis points, that is 0.25% lesser than the repo rate. But reverse repo was discontinued since April 2022, right? In place of reverse repo, RBI and banks now use something called as standing deposit facility rate. What is it? It is same as reverse repo, but here the RBI will not take, the scheduled commercial banks will not take any collateral from the RBI. That is, they do not take G securities from the RBI. Just the scheduled commercial banks deposit certain excess funds with the RBI, and RBI pays a rate of interest, and this rate of interest is nothing but standing deposit facility rate, right? So how does this reverse repo rate and standing deposit facility rate affect the inflation in the market? Let's say RBI increased the standing deposit facility rate like for 20% or 10%. Right? What it encourages? It encourages the scheduled commercial banks to deposit more funds with the RBI, yes or no? Because it is a safer loan, number one, and it is getting more interest than whatever the people are willing to pay. So what is happening? It is depositing its funds more and more with the RBI. That means what? It has less and less funds to give to the common public. That means common public and the companies have less and less money. Less and less money means less and less demand in the market. That means lesser inflation, right? If the RBI decreases the standing deposit facility rate to say 2%, then what these scheduled commercial banks do, they will give these loans to consumers or the common people who are willing to pay 6% of interest, right? So what? More and more money, more demand, more inflation. That is how repo rate or reverse repo rate and standing deposit facility rate work controlling the inflation in the market, right? We are done with liquidity adjustment facilities. Under liquidity adjustment facilities, we've seen repo rate, reverse repo rate, and standing deposit facility rate, right? Now we enter into something called reserve ratios. We've already seen what cash reserve ratio is. Cash reserve ratio is the percentage of NDTL, net demand and time liabilities, that the banks has to deposit with RBI in form of cash, but RBI will give nothing because it is not going to pay any interest rate. That is how we used to calculate what? Marginal costs based lending rates, right? We've seen the concept of negative carry on CRR, right? Okay, how does this work? How does this impact the prices in the market? Let's say RBI increases the CRR too much, like say 50% of the NDTL have to be deposited with the RBI in form of cash, but it is not getting any interest rate. What does banks do? Banks have less and less money, and because it have to cover the NDTL, it increases the rate of interests, and even the little loans it gives are on high interest rates at, let's say, 60% or 70%. Who is going to take loans at this rate? No one is going to take loans at this rate. So less demand, less money supply in the market, less demand in the market. That means less inflation in the market. Then there is another thing called as statutory liquidity ratio, that the percentage of NDTL that the banks have to keep with themselves in form of cash, gold, or SLR securities, that is statutory liquidity ratio securities. We'll see what these are also in chapter capital market. These are securities, that is same like bonds, right? One example is treasury bill again. Okay, how this works? The same way, the more it have to keep it in with the bank itself, the less amount of money it can give to the common public. That means less money supply in the market, less demand in the market, less inflation, right? If it is too low, it can give more. That means more money supply in the market, more demand in the market, more inflation in the market. There's another thing called marginal standing facility rate. Under this, the scheduled commercial banks will take some loan or money from the RBI, but it has to give some collateral, that is G securities, and later on it have to pay the rate of interest to the RBI. These are generally overnight, and only 1% of NDTL can be taken as loan. And to get this, the scheduled commercial bank must have a current account with the RBI, and it can only take in terms of 1 crore and its multiples, right? Where x is 1, 2, 3, not 0, greater than 0, right? So I've told current account, and I've told we'll see a few types of accounts, that is current account, there is saving accounts, then there are loan accounts, then there are fixed deposit accounts. Current accounts are basically demand deposit accounts, let's say. So under this, we can use frequent transactions, basically for traders or businessmen. Savings for individuals to save money and earn interest. Under savings account, if you deposit some money, you will be earning interest on this. Under current account, if you deposit some money, you will not be earning any interest on this. There is loan accounts where your loan will be sitting, and there are fixed deposit accounts where the tenure is too high and you will be earning basically more interest than all this, right? So these are the types of accounts, and RBI has to have a current account with RBI for day-to-day transactions. Okay, we've seen what marginal standing facility is. The same thing. What happens if the rate increases too much? That means the scheduled commercial banks works like repo rate. If it is too high, that means the rate of interest that the scheduled commercial banks will give to the consumers will be also too high. Too high rate of interest means lesser money supply in the market, because less and less people will take loans. Less money supply, less demand, less demand, less inflation. Right. So we've done with the quantitative monetary tools. Let's look into the qualitative monetary tools. Starting with priority sector lending. What is priority sector lending? RBI will mandate the scheduled commercial banks to give the percentage of the total loans to certain sectors like agriculture, MSMEs, and exports, education, housing. For example, for agriculture, the banks have to give 18% of their total loans. That is priority sector lending. So, how does this priority sector lending impact the inflation, right, in the market? Let's say 40% of the loans are given to agriculture, right? These are more risky loans. What is a risky loan? More risky loan, I said. So, more often than not, the agriculture or the farmers tend to default on their loans, because India is still dependent on rain, right? Majority of the population, like let's say 70 to 80%, I'm not sure about the number, but 70 to 80% of the Indian land, agricultural land, is still dependent on the rain. If there is too much rain and floods happen, there is loss for agriculture. If there is too little rain and droughts happen, there is loss for the agriculture. So the farmer will not be in a position to pay back the loan. So in order to cover the defaults of these loans, the banks may increase interest rates to other people, right? Or banks may reduce the amounts of fresh loans that are being given to farmers, right? What happens when there is more interest? What happens when there is less loans given to the farmers? That means less investment they have. When they have lesser investment, what happens? They produce less. That means what is happening? The supply is low. When the supply is low, what happens? The cost of the production, supply pull inflation, the cost of production for farmers or the companies increase. So what happens? Total inflation increases. For example, under priority sector lending, banks have to give, let's say, 20% to MSMEs. These MSMEs will create some jobs. That means more and more people will have purchasing power. That means more demand in short run, right? Because they go and immediately spend it at the market. That means immediate demand in the market. That means immediate inflation in the market. But what happens after some time? Because there are more and more MSMEs, there are more products in the market. So in short term, it leads to a bit of inflation. In long run, because there are more products, that means there is more supply. When there is more supply, what happens? The price falls. Yes, this is how priority sector lending rate also impacts inflation. So what are the advantages of priority sector lending rate? One, it ensures financial inclusion. That is, farmers generally take loans from money lenders, private money lenders. These money lenders charge high rate of interest, right? So instead of farmers going to the money lenders, private money lenders, we are including these farmers into the banking structure of India. We are including the farmers into our financial institutes. That is, financial inclusion is ensured. And next, employment generation is ensured, because we've seen how MSMEs will lead to more employment generation. And then there is enough credit diversification. Without priority sector lending, the banks would often lead to more and more corporate sectors, right, at basically lower interest rate. So what happens? because there is a lesser amount of loans that are given to farmers or MSMEs, these sectors face an issue. So because there is less investment for farmers, there is a lesser production by the farmers. If there is lesser production by the farmers, there is lesser supply in the market. What happens when the supply is too low and the demand is constant? The prices increase, right? There is inflationary effect in the market. Priority sector lending rate also ensures social justice. That is, the farmers will be saved from the debt traps because of high rate of interest that they will otherwise get from the money lenders in the market. When they instead choose banks, they will be getting a fair rate of interest compared to the money lenders in the market. Right? Will ensure social justice. What are the disadvantages of high priority sector lending? Number one, banks don't have autonomy. That means they cannot give loans to the corporates. That means there is lesser profits for the banks, right? Because corporate take a huge amounts of money and they pay back. But also because agriculture is still an unpredictable game in India, more rain-fed crops in India, more often than not, the farmers default the loans. That means more non-performing assets. Will look what non-performing assets are very soon, but basically understand these are the assets. What is an asset to a bank? We've seen it is a loan that the bank gives. This asset is not performing, sir. That means it is not getting its asset back or the interest back, right? Basically, defaulted loans we can call non-performing assets. We'll clearly see what it is very shortly. So because of this high NPAs, what happens? Banks profitability decreases. And also when the farmers take loans for investing in agriculture, they rather sometimes spend for day-to-day expenses rather than investing in agriculture. So misuse of loan happens, right? Once they spend their loan on food or clothes, right, they cannot invest again. If they cannot invest, they cannot produce, so they will not be in a position to pay back, right? There is operational burden on the banks because in the villages we have to, even to recover the loans, we have to establish branches in the villages. We have to look where the farmer is living to recover the loans, etc. The operational burden increases because the non-performing assets increase. The next qualitative monetary tool is credit rationing. That is, RBI restricts maximum credit that a bank can offer or maximum loan that a bank can offer to certain sectors. For example, a broker in agriculture mandi or a person who will buy too much onions. For example, what happens is if the banks give loan to a broker or a broker of an agriculture mandi, what he does, he buys or hoards. What is hoarding? Buys excessive amounts of onions and stores them in cold storage. What happens when he buys excessive amounts of onions? The supply of onions in the market decreases. What happens when the supply of the onions in the market decreases? The inflation increases. That is nothing but the price increases. Because the price increases, the broker will now sell these onions that he has rather bought at a cheaper price for profit, right? So to prevent sudden spikes of fluctuating commodities or volatile commodities like onions, right, RBI prevents maximum credit that banks can lend to certain sectors, right? Prevents speculative hoarding of commodities. Then another qualitative tool is margin requirements. So RBI mandates banks to give certain percentage of an asset. Banks take collateral as an asset, for example, land or a house, and the banks won't give 100% value of land as loan to you. Why? Because RBI mandated it so, right? So maybe the bank will give, like say, 70% or 80% of the land value as a loan to you, right? Another example is stocks. What happens when this happens, when the margin requirement is too high? For example, when the RBI mandates the banks to give only 50 percentage of the total asset value as loans, less and less people will go for loans because our asset value is too high. So what is happening? Less people will take loans from the bank, less demand, right? Or something might happen more, and like people will not choose banks to get loan, but they will sell off their properties. And if they sell off their properties, there is more money, more demand. So based on that and based on the asset, right? Uh, if RBI decides that certain amount of the asset can only be given as loan, this also have impact on the market prices, that is inflation, right? The next one is direct action, like penalties for not following the rules, or penalties for giving at lower interest rates for corporates, etc., etc. Then morally persuading the banks through advisors meetings. For example, give more loans to MSMEs or more loans to that agriculture, right? Then there is another thing called consumer credit regulation. Under this, RBI decides or mandates banks to take how much percentage as down payment for certain loans, for example cars, right? If there is no such down payment, what happens? More and more people will buy new cars. That means more and more demand to the cars. What happens when there is more demand? There is inflation in the market. Makes sense? Yes. So we were dealing with the functions of RBI. Number one function is controlling inflation. We've seen how RBI uses monetary tools, both qualitative and quantitative, to control inflation in the market, right? Next function of RBI is a currency authority. That is, it mints and prints the currency in India, except 1 rupee notes and all coins. All these coins and 1 rupee note is minted and printed by Ministry of Finance, right? If we are making notes, we call it print. If we are making coins, we call it mint, right? So RBI is the currency authority, right? It prints the notes, all notes except 1 rupee note. These 1 rupee note and all coins are printed and minted by Ministry of Finance. So if you see here, on any note there is a signature of RBI. That means RBI is a currency authority. The RBI prints the currency. So what is the biggest denomination that can be printed in cash? It is 10,000. Can be printed. It was once printed, but it is not in circulation as of now. What is the largest denomination in coin that can be minted? That is 1,000 rupees. Right. There is another concept of seigniorage. What is a seigniorage? For example, RBI prints a 2,000 currency note. What is the cost of production of this 2,000 currency note? Let's say for the rent, for the capital machine, and for the land, and for the wages, and etc., etc. This costs around, let's say, 20 rupees, right? So 2,000 minus 20 rupees, it is 1980, right? This 1980 rupees is a profit. Let's consider it a profit to RBI. This is nothing but seigniorage. This definitely seems like a very profitable and lucrative business. That is exactly why a lot of people go on with the counterfeits. But let me remind you that counterfeit is a heinous crime. The punishment for it, printing counterfeit currency, the punishment for it is either life or 10 years, according to section 489 of Indian Penal Code. So we're done with certain topics and subtopics under central banking. Post this, we will look into the banking structure of India. What are the different banks of India? What is NABARD? What is Agriculture Bank? What is Regional Rural Bank, etc. and etc. We will also look into recommendations of certain committees. Right? We'll also look into Basel norms that the banks have to follow. We also look into another functions of the RBI, that is manager of foreign reserves, that is being a banker to the government, right, etc. so forth in the coming lectures. But this is the end of the demo classes. We'll be starting to offer you guys recorded lectures which will be available for very affordable prices, less than $1,000 per month. Stay tuned for the next topic.